Welcome again, dear students and scholars. We now reach the final video in our ASC 260 earnings per share series. The core methods are complete: basic EPS, treasury stock method, if converted method, ranking, and anti-dilution. Today we cover advanced EPS issues at a practical exam ready level, then lock the topic through practice. The goal is not to overload you with every rare corner of the standard, but to make sure you can recognize advanced issues, place them correctly, and solve the kind of questions that appear in exams and real reporting. Here is the learning path for this final lesson. We begin with advanced instruments, then move into participating securities and the two class method, then connect ASC 718 share based awards to EPS, then review disclosure, and finally practice through MCQs, calculation drills, ranking, and a final memory map. Notice the structure: technical coverage first, practice second. We are not reteaching the whole series from zero. We are converting what you already learned into testable mastery. For advanced EPS questions, use three control questions before calculating. First, could additional common shares appear? Second, should earnings be allocated before common EPS is computed? Third, would including the instrument actually dilute EPS? These three questions prevent panic. Advanced EPS looks difficult when every instrument feels special. But once you route each instrument through these gates, the problem becomes much more manageable. A contingently convertible instrument may convert only when a market price trigger is reached. Students often think that if the trigger has not been met, the instrument can be ignored for diluted EPS. That is not automatically correct. Under ASC 260, the instrument still needs to be tested for dilution. The market trigger does not replace the dilution test. So, identify the conversion terms, test the effect, and include the instrument only if it is dilutive. Contingent stock issuance requires careful distinction between basic EPS and diluted EPS. For basic EPS, contingent shares are included only when the condition is actually satisfied. For diluted EPS, the test asks whether the condition would be satisfied if the end of the reporting period were the end of the contingency period. And then the instrument must still pass the dilution test. So the key is not whether shares are theoretically possible. The key is whether the ASC 260 condition gate has opened. Some contracts may be settled in either stock or cash. The wrong instinct is to say, if cash is possible, there is no dilution. ASC 260 does not let us take that shortcut. If the entity controls settlement, stock settlement is generally presumed. If the holder controls settlement, the more dilutive outcome is generally presumed. After applying the settlement assumption, we test whether the result is dilutive. EPS follows the standards assumption, not the easiest story. The reverse treasury stock method applies to certain own share repurchase contracts, such as written puts or forward purchase contracts. Think of it as the mirror image of the treasury stock method. Ordinary options model possible share issuance. These contracts model possible share repurchase obligations. The method considers whether the entity may need to issue shares at the average market price to fund the repurchase obligation, and only the net effect enters diluted EPS. Partially paid shares require attention to rights, not just labels. If the holder has paid only part of the issue price, we ask whether the shares currently participate in dividends or earnings. If they participate in proportion to the amount paid, EPS may include them on a proportional basis. If they do not participate until fully paid, they may be treated as potential common shares for diluted EPS. The exam point is simple. Read the economic participation rights carefully. Preferred conversion events can affect the EPS numerator without changing reported net income. If preferred stock is redeemed at a premium, the excess may reduce income available to common shareholders for EPS purposes. If an entity gives additional consideration to induce preferred holders to convert early, that incremental consideration can also reduce income available to common shareholders. The key is that these are EPS numerator adjustments, not ordinary income statement expenses. Participating securities are instruments that share in dividends or undistributed earnings with common shareholders. They may include convertible preferred stock with participation rights, non-vested share awards with non-forfeitable dividend rights, or other instruments with contractual earnings participation. When these instruments exist, we cannot simply give all earnings to common shareholders. We first allocate earnings between the participating securities and common shareholders. The two-class method is the answer to that allocation problem. Step 1 is to allocate earnings between common shareholders and participating securities based on their participation rights. Step 2 is to compute EPS using only the common shareholders allocated portion as the numerator. This method does not replace diluted EPS. It changes the numerator that feeds into basic EPS and, where relevant, diluted EPS. Now look at the two-class example facts. Total earnings are $500,000. Participating securities receive an allocation of $50,000. Weighted average common shares are 100,000. The important point is that the full $500,000 does not belong to common shareholders. The participating securities have a claim, so that allocation must be removed before computing common EPS. The calculation shows the effect clearly. Start with total earnings of $500,000, subtract $50,000 allocated to participating securities. Common shareholders' earnings are $450,000. Divide that by 100,000 common shares, and basic EPS under the two-class method is $4.50. If we use the full $500,000, EPS would be overstated at $5. ASC 718 links to EPS because share-based payment awards often create potential common shares. Employee stock options may use the Treasury stock method. Non-vested shares may require Treasury stock method treatment or two-class method treatment depending on participation features. Performance share units may involve contingently issuable share rules. The important reporting connection is that compensation awards do not stop at compensation expense. They often flow into diluted EPS analysis. Non-vested share awards need special attention when they carry non-forfeitable dividend rights. If the holder receives dividends even during the vesting period and does not lose those dividends upon forfeiture, the award may be a participating security. If so, the two-class method may apply and the award can affect basic EPS by receiving an earnings allocation. This is a common trap because students think non-vested awards affect only diluted EPS. ESOP shares in master limited partnerships are specialized areas. For employee stock ownership plans, unallocated shares are generally not treated the same as outstanding shares for basic EPS until they are allocated or committed to be released. Master limited partnerships often use earnings per unit and apply allocation logic under the partnership agreement. The exam strategy is to recognize the issue without overbuilding a full specialized model unless the syllabus clearly requires it. EPS disclosure helps users understand how the numbers were built. A good disclosure reconciles net income to income available to common shareholders and reconciles basic weighted average shares to diluted weighted average shares. It also identifies instruments excluded from diluted EPS because they were anti-dilutive. This matters because two companies may report the same diluted EPS number but have very different potential dilution sitting outside the calculation. Use this final workflow on every ASC 260 question. First, confirm scope and whether EPS is required. Second, compute basic EPS by controlling the numerator, denominator, and any two-class allocation. Third, identify potential common shares and apply the correct diluted EPS method. Fourth, rank and exclude anti-dilutive instruments. Fifth, present and disclose the result properly. This sequence keeps the topic organized from first fact to final answer. Now we begin practice. MCQ1 asks, which item belongs in diluted EPS? Treasury shares, out of the money options, dilutive convertible debt, or common shares already outstanding? Take a moment to choose your answer. Remember that diluted EPS includes dilutive potential common shares, not treasury shares, not common shares already counted in basic EPS, and not instruments that are anti-dilutive. The correct answer is C, dilutive convertible debt. Treasury shares are not outstanding and do not enter EPS. Out of the money options are generally anti-dilutive and excluded. Common shares already outstanding are already included in basic EPS, so adding them again would double count. Dilutive convertible debt, however, is a potential common share instrument. If it reduces EPS under the if converted method, it belongs in diluted EPS. MCQ2 asks what the two-class method is doing. The choices are allocating earnings first, ignoring participating securities, using only market price, or replacing diluted EPS. Think about the problem the method solves. It is not a market price method and it does not eliminate diluted EPS. It deals with earnings allocation before common EPS is computed. The correct answer is A, allocating earnings first. The two-class method allocates earnings between common shareholders and participating securities before computing EPS. It does not ignore participating securities. It does not use only market price, which belongs more naturally to treasury stock method thinking. And it does not replace diluted EPS. It modifies the numerator that feeds into the EPS calculation. Now we review the treasury stock method with a calculation drill. There are 12,000 options outstanding. The exercise price is $25 and the average market price is $40. Before moving to the answer, calculate three things: assumed proceeds, shares repurchased, and incremental shares. This is the same sequence from video 5. Issue, repurchase, add only the net. The assumed proceeds are 12,000 multiplied by $25 or $300,000. At an average market price of $40, those proceeds repurchase 7,500 shares. The options assumed exercised are 12,000 shares, so incremental shares are 12,000 minus 7,500, which equals 4,500. Only 4,500 shares enter diluted EPS, not all 12,000. Now rank the instruments. Employee options have a $0 incremental EPS effect. Convertible debt has a $1.20 effect. Convertible preferred has a $2.10 effect. Your task is to rank them from most dilutive to least dilutive. Remember that ranking is not based on share count, instrument size, or which item looks more complex. It is based on incremental EPS effect. The correct ranking is employee options first, convertible debt second, and convertible preferred stock third. Options with zero numerator effect are the most dilutive when they add shares to the denominator. Debt enters next at $1.20. Preferred enters last at $2.10. After each inclusion, EPS must be recomputed. If adding the next instrument increases EPS, that instrument and the remaining lower ranked instruments are excluded. Now answer the short question. Why are anti-dilutive securities excluded from diluted EPS? A strong answer has 2 points. First, diluted EPS is designed to show potential reduction in EPS, not improvement. Second, an instrument is anti-dilutive when including it increases EPS in a profit scenario or reduces loss per share in a loss scenario. ASC 260 excludes those instruments, so diluted EPS shows genuine dilution, while material excluded instruments are disclosed separately. That completes the ASC 260 series. You now control the full map: scope, basic EPS, diluted EPS, two-class method, advanced instruments, anti-dilution, ranking, and disclosure. More importantly, you know how to approach the topic in sequence instead of guessing from isolated rules. If this series helped you, please like the video, share it with your colleagues, subscribe to Commerce Regiment, and support the channel. In the next accounting standard, we will continue building the US GAAP course with the same clarity, structure, and exam focus.